Hi, everyone. Welcome and thank you for joining us today. My name is Yana Kolmakova and I'm the Marketing Director. Here at US Analytics, our mission is to empower the finance office to drive strategy and picture results. Through working with our clients and monitoring the market, we've recently seen this need to address the topic that we'll be covering today, automating and transforming account reconciliations with Oracle ARCS and FCCS. As you may know, account reconciliation is the #1 non-data related delay in the close process, and if you're manually completing reconciliations, you have a great opportunity to speed up your close with the solutions we'll be covering and talking about today. Before we begin, I'd like to introduce our organization. We are a leading professional services firm with over 20 years experience focused on various EPM and analytics solutions, serving corporate finance teams nationwide. Our seasoned teams are highly technical and functional, and we pride ourselves on being an aligned strategic partner with our clients. Okay, now that you've gotten to know a little bit about us, I'd like to launch a series of polls so that we can better get to know you and serve you best. So I'm going to go ahead and do that now. Please answer as quickly as possible, and we will keep this moving along. Fantastic. Thank you, everyone, for answering those. Okay, I'd like to take a moment to introduce our presenter. We're joined today by our subject matter expert and practice lead for financial close and consolidations, Nair Ellis. Her experience varies across numerous roles, including financial controller, developer, implementation specialist, trainer, mentor, project lead, and manager. So she has been directly in your shoes, is well-versed, and knows and understands the pains you may be dealing with when it comes to close. A brief overview of what we'll be covering today. We're going to dive into best practices for account recs and some pain points. We'll do intros and kind of a deep dive into Oracle ARCS and Oracle FCCS. We're also going to talk about how cloud adoption and kind of entering into the Oracle Cloud Suite, how account recs is an easy and timely first introduction into cloud, and then we'll finish off with a client success story, someone that we have helped directly implement both ARCS and FCCS and the results that they've seen. And then we'll wrap everything out with the Q&A session. So I encourage you all to ask questions as Nair goes through the content and teaches us today, and we'll answer those in the very end. And then the last thing I want to mention before I turn it over to Nair is that this webinar is actually the beginning of a 3-part series on account reconciliation. So we'll post some information about that later on in the slide deck, and we will email you as well the registration pages for those. So without further ado, Nair, I'm going to turn it over to you, and you can take it away and educate us today on how we can speed up our close.
Perfect. Thank you so much for the intro. Okay, best practices. So, I just want to lead into this with, this isn't a new topic, right? We've talked about account reconciliations and FCCS before. They've been out on the market for a while, and there's a lot of name recognition around it, but we want to refresh everybody's memories on that and just go through some best practices, go through some application features, and then, like Yana said, we're gonna talk about a case study and try to bring it home, real world, relatable to an everyday user. So, some of the best practices just in industry wide, right? You want to centralize your close calendar. You want to have the ability to have it all in one spot, corporate consolidations be able to manage it, and have it be visible to everybody. That, when you're working in an Excel environment, that becomes a little more difficult to maintain. It's variations of versions, things like that. Something that people tend to forget is you can manage that along with your reconciliations and your financial consolidations information within the application. So, having a centralized close calendar can and should be a part of your close process. You can unify your chart of accounts, right? Various companies, when you've got mergers, acquisitions, things like that, everybody brings in their historical chart of accounts, their historical structures. You don't necessarily want to rock the boat, and people are more comfortable keeping their ERP systems intact, and that's fantastic. But when you get into the reporting, it's better and easier, simpler to unify it, right? And it makes it easier for various reporting. It makes it easier for quicker turnaround on your consolidations reports. So you can do that within your close and consolidation system without hindering any of your ERP and standalone entity information. Specifically more on reconciliations, you can have different risk levels on your reconciliation types, and you should. Not every reconciliation needs to be treated the same, and ARCS allows you to do that while still having a unified approach to the reconciliations, right? So you can look at them differently, treat them differently, analyze them differently, but still have it unified. And then you can automate all of this, right? You can have behind the scenes, have the systems being refreshed, updated with all this information, no human interaction, no manual compilation of things. Everything is fed directly to the system. The fewer times it's touched in between, the better it is, right? It just allows for fewer mistakes. So let's talk now about some specific pain points. First, we'll take a look over here on reconciliations. Preparations can be very manual and time consuming. You're grabbing your balances over from various GL systems. You need to grab your trial balance data. You need to grab the detailed subledger data and put all this together. So the grabbing of the various pieces in itself can be cumbersome. And then when you factor in pulling from, whether it's the same system or different systems, there's still a lot of pieces to put together. And then you've got to roll over from prior months to ensure you've got the correct starting and ending balances. All of that, all your checks and balances and compilation of information takes so much time before you even get started on your reconciliation. And it takes all that time that you're spending compiling is taking away from your ability to actually review the transactions. And then when you get different users, different account types, you come across inconsistent formats, and that becomes problematic as well. It makes it harder for the reviewer. It makes it more difficult to transition between various people. If you've got new staff coming in or old staff promoting up, whatever it may be, when you've got inconsistent formats, it just makes it harder for the preparer as well as the reviewer. And then keeping a track of where everything is, when you're trying to track that outside of the system, that also becomes quite cumbersome, and it's a manual effort, and you might go check off the first 3 and then you forgot to check off the next several, and so it becomes kind of a tracking nightmare as well, in addition to all the responsibilities of just maintaining the reconciliations. And that's, I think, regardless of company size and regardless of company industry, that's just something you encounter, right? And then on the consolidation side, same, kind of similar concept. It's very manual to prepare these things. If you're doing it within Excel, you're grabbing you're extracting a trial balance from your systems. And if you've got multiple systems, then you're having to grab trial balances from various systems that may or may not even be aligned. and you're putting them together with this within the spreadsheet, and then trying to have like a summary tab to put all this information together. You're trying to track it by financial statement line item, trying to line everything up so that it rolls into your balance sheet, income statement. Very, very manual effort. And then if you've got any new activity, new accounts, new changes in your structure, that shifts all of your existing, your existing files, so that when you're rolling month over month, you run into issues there. And then it's fairly common to go and make topside entries within these Excel reports. So okay, great, we got our trial balance in there. Okay, well, we need to make some topside classification changes for deferred taxes, things like that. It just makes it hard to track the flow of the data. And then it becomes error prone due to all these manual preparation efforts. And you can, in addition to footing errors, inconsistent classification period over period, those are just some common issues you might run into. And then a lot of times, once everything is said and done, you have a final version of a report. But you might have 11th hour changes, which I know every accountant is well aware of and has experienced. So those 11th hour changes may not make it into the document that's marked as final. So that's another issue that when you're rolling period over period, you might not realize until you're in the final stages, and then there you are again at the 11th hour trying to fix your comparatives or things like that. And then, again, because of all this, all the tracking, all the version issues, all the, pulling of various sources, when you have to go back and recreate for audit purposes, it becomes difficult. Try to prove out to auditors how you got from point A to point B, and it becomes a nightmare and leads to audit adjustments, things like that. So again, it's a pain point. Those are pain points that I know most accountants can relate to, because it happens across the board. I've seen it at every company I've gone to. But I get it. Every accountant loves Excel, right? I do too. I still, to this day, spend a ton of time in Excel. And you can still use Excel with these tools. That's the beauty of it. You can still use Excel. They have an add-on called SmartView that allows you to do your analysis and do your drilling into details and finding your variances and finding all the information you need, but it's within the system, so it has the data integrity there. And you're always looking at the same set of information, just might be slicing it and dicing it differently. So and we'll get into that as we kind of talk about these product features. But Excel is great and it's not going anywhere, but you can do it within the constraints of the system. So let's talk a little bit more about, we're going to shift back to ARCS here now. Let's talk about the product features. Let's talk about how you can do better within the application as opposed to housing all of your reconciliations across multiple Excel files. ARCS has flexible formats, so you have templates that you can create and set up, and those formats allow you to do, okay, do I want to do an account analysis? Do I want to know, no matter what the balance is, I need to know what derived it at the end of the month? Or is it an account where you're more interested in the shift or change of balance period over period? You can set them up that way. You can assign different attributes to them. There are a lot of flexibilities around the formats that you might want to create for each type of reconciliation. You can manage the process more efficiently with the workflows. You can know when the period is open, the reconciliations have been created, then like the preparer is notified, can go in and start the preparation of their reconciliations. They can submit it, and there's a workflow that captures each stage of the reconciliation, and keeps it all in control. You can define your own rules and account profiles. So the driving feature for all these reconciliations are profiles, and these profiles can have their own set of rules, their own set of risk ratings, and you'll want to do that by account type. So for your cash accounts, you're going to want a higher risk rating than you might want for prepaid rent or something like that. So you can assign it by type of account and apply it across the board. And then each of those might have rules associated with them. And we'll talk a little bit more about the rules as we go on in the presentation. You can automate zero balance reconciliations. If I have an account that has no balance and no activity for the period, I don't even want to look at it. I want it signed off and check the box. And you can do that. You can set up rules to say, okay, if there's nothing going on here, let's tick tie and auto submit it, like we've at least checked for it. That's a huge time saver. You can automate intercompany reconciliations. You along with kind of some of those rules and the profiles, settings and attributes that we were just talking about, you can automate and a lot of these reconciliations, and at least even get it 75% of the way there, and that's a huge time saver. You can evaluate and improve close cycle effectiveness. With the workflows are tied to dashboards, and those dashboards you can see real time, where do we stand on this? So that kind of goes back to part of the managing the close cycle. You know where you're sitting on all these reconciliations. You know who's late, who's on time, who's submitted their reconciliations, who hasn't. You can just, with a few clicks of a button, you can drill through and see and go to exactly what reconciliations are outstanding and deal with those. Easily identify outliers. As there's a degree of machine learning, if I guess, for lack of a better term, you can have it recognize what things are kind of out of the ordinary and mark those items for explanations. And that's part of kind of the transaction matching stuff that we'll be talking about in the presentation as well. And then, providing audit support. You can, again, with those dashboards, with the workflow, you can give auditors limited access to the system, and they can go through and they can check the history. When was it prepared? When was it submitted, reviewed, signed off, closed off? They can go check that all themselves. No need to keep copies of paper signatures and prove out when things were done. So transaction matching is a module within Oracle ARCS that it's a very powerful engine. It can automate a high volume of transactional reconciliation items. So a lot of reconciliations have high volume, low risk transactions that need to be addressed. You can have transaction matching tick and tie all of that for you. You can set up rules within. You have rules that you can set up for the reconciliation itself, but you can also have rules within transaction matching where you can say, if the invoice number matches and the amount matches, go ahead and reconcile it. If the date and the amount match, but the invoice number is off, set it up as a suggestion for me. So you can have suggestions that you can either confirm or decline. So there's so many different ways you can set that up, so many different rules. and so many different attributes. So you're not limited to like invoice and date and amount. You can add several attributes to check against, and you can have ranges of acceptability. If it's within $1,000, you can still, and the invoice number matches, go ahead and still reconcile it. I don't want to deal with it. You can set things up like that. If it's within your materiality threshold, you don't want to spend the time, or you don't want to have someone come in and spend the time on information like that, then you can just have it reconciled. You can automate journal entries. So if you have suggestions or if you have variances that have been identified during this transaction matching process, you can either manually or automatically have journal entries created to reconcile the difference, and book a journal entry for those variances. So it's all very integrated and intertwined, and is a huge time saver. Again, like especially for those low risk, high volume accounts where you can spend hours and hours ticking and tying something that doesn't really provide you much benefit, why not have the application just handle all of it, right? So let's switch gears now, and we'll talk a little bit here about we'll go ahead and kind of just review our benefits we've got here for ARCS, and then we're going to switch over to FCCS. So ARCS, very user-friendly, very intuitive, and the automation of risk-based reconciliations, huge. I mean, the time saving you can have around that is just, it's pretty insane. Even if a reconciliation only costs you 15 to 30 minutes, if you multiply that times having 40 different accounts that you're responsible for that are low risk across 5 entities, that's several hours of time savings that you can have a system just automatically do for you. You can have custom calculated attributes, which lead to more powerful automated rules. So the more detail and attributes you're assigning to each of your profiles and your templates for each type of reconciliation, whether it's cash or AR or whatever it may be, you can really get very creative with these automated rules and have it address a lot of your reconciling items for you. Again, with the real-time dashboard reporting, that's especially for the reviewers and the CFO, that's very powerful tool, just to at a glance know where everything stands and making sure things are tracking properly for your month-end close timeline. The automated transaction matching, again, you could just, with all the machine learning and automation, it can really be a huge time saver. And it's an easy tool. Like I said, it's very intuitive. Just a functional resource, a power user on the accounting group can manage it. You don't have to rely on an IT department to manage this information for you. It's very easy for a power user to get in there and say, okay, well, we've got a new entity account combination, or at whatever level it may be that you're reconciling. You're not limited to entity and account. I just use that as an example because that's what most companies go for. But there are companies out there that do it at a account and sub-account level, whatever works for your company. It's very flexible in how it's set up. The example we're going to talk about, they had it set up for entity and account for most accounts, but for some accounts, they wanted entity account subledger level, and that's okay. So moving on into FCCS. Again, there's a lot of functionality and a lot of powerful calculations that are already in this application day one. As soon as you turn it on and configure it, you've got a good skeleton structure in place to hit the ground running. You can get up and start quickly in with built-in best practices. You can meet your needs without customizations. We've had all levels of implementations. We've done implementations that have quite a bit of customization and custom rules. We've had some with a moderate level, and then we've had some that have zero customization. And that's entirely possible because a lot of the common practices are already built in to the application, because regardless of what company you are, regardless of what industry you're in, everybody needs to be able to consolidate up to their totals. They want to be able to have a consolidating view so they can see how things are rolling up. They want to be able to see intercompany, and they want to have their end numbers. And so that's a common need. It's the same need across the board, and so that is something that's already built in for you, which is what makes it so easy to just hit the ground running and makes it possible to have an implementation with zero customization. It has global reporting requirements built in if you need it. You don't have to configure it that way, but you can have it configured to have separation for IFRS versus GAAP reporting. Or if you need GAAP versus stat reporting, you can have that as well. Whatever your company needs may be, but you have the ability to have that meet those global reporting requirements within the same application. You can perform complex consolidations out of the box. So here you can see we've got just at day one, open and configured, you have your consolidation and your basic consolidation and translation rules built out for you. Assuming you're following or taking advantage of the seeded pre-built content that Oracle provides you. You can manage your KPIs. You can, again, out of the box during the configuration process, you can have some pre-built ratios. And then you can build in your own as well. Even though this is the cloud version or cloud replacement for HFM, it doesn't function the same as HFM. You have more of the planning benefit of being able to build out member formulas, things like that. So you can build out ratios using member formulas, or you can have just stat calculations, earnings per share, EBITDA calculations, all of these kind of general things that most people use. It's very easy to build in based on whatever numbers you have that feed into those calculations, whatever numbers or KPIs or numbers are meaningful to you. You can automate the intercompany eliminations. When you initially configure FCCS, you're marking your accounts as intercompany and assigning a plug, just like you would do in most applications. But out of the box, you have an intercompany elimination matching report that you can refer to. So very powerful to have that pre-configured report available to you. Currency translation. You can, when you configure the application, you can mark it as a multiple currency application and drop in any input currencies that you need. Then you would put in your reporting currencies, and at that point, the system can triangulate any input currency to any reporting currency. So you can, at any level within your entity hierarchy, report at any reporting currency that you have put into the system. So that's huge. You can set up, there are people who set up multiple hierarchies to account for various reporting currency requirements. You don't need to do that. You can do it all within one hierarchy. So that's huge. And if referring back to Excel, trying to maintain that translation adjustments outside of the system or within Excel or within your ERP, it gets to be quite cumbersome and error prone. So with this system, out of the box, you have your average translation, your month end true up entries, all of that just automatically booked for you with the click of a button. You can enable audit compliance. You can see who's done what when. If numbers have changed and you don't understand how updated numbers got into the system, who loaded the latest file, what did they load, you can refer back to all of it. You can drill back to all of it. There's no mysteries. It's all within your audit compliance, and you can drill back to all the way back to the source. So it's completely transparent, easily trackable, very, again, like I said, no mystery. You know exactly where the numbers came from. You can work your way back to it. Supplemental data. This is data outside of your traditional trial balances. So you can maintain this information within the application as well. We've got the pre-built content, we've got the pre-built balance sheet and income statement structures, the pre-built consolidation rules. And now we can also incorporate all our supplemental information into the application. You can build out roll forwards. You can build out detail behind your AP balances. You can put that into the system. You can, there have been cases where people want to have supporting subledgers by segments, and then calculate out values and then push those values into some stat accounts within the system. So you can have the supplemental data information, perform a calculation and push it back in, push a value over into your system to then include on reports. It's a very powerful tool for data in addition to your traditional trial balance. And it's all intertwined and pre-configured. So what are the benefits of cloud adoption of account reconciliation and FCCS? And I mean, these are just some stats on, just kind of the level of benefit you're getting from in various sections of your closing consolidation process. There is quite a bit of benefit to be obtained from making the switch. As you can see, we went from being in the 20s to 60 to 80%. That's a huge savings, and that gives you as the preparer, as the reviewer, as the one responsible for the financial information and providing that to management, to investors, big, whoever your output may be going to. That gives you time to actually analyze it and look at your values, as opposed to spending all your time just compiling and crunching numbers. That reduces your back and forth and increases the reliability of the information that you're providing out. So, we've done and some surveys and gathered some information, and the stats kind of speak for themselves, right? You've got huge time savings. 84% of people reported reducing the number of days per close cycle. And you can get from how many of it may be. I personally have brought close times down by several days. It's having the system automate most of your processes can really reduce the amount of time you spend each month. It's just, there's so many companies that go from closing out 1 month and turning right around and starting pre-close procedures for the next month with no gap. It's an endless cycle of close, and it shouldn't be that way. And that kind of goes hand in hand with the amount of time saved and agility gained. You can reduce the number of days to plan per cycle. There's so much of this information that can be rolled to the next period. You don't have to maintain and plan out for the next stage. And it's just, you can have a complete connected solution and have a good overall return of investment with the automation and with the use of these applications. So when considering migration, what are the kind of things you need to be thinking about for your overall vision? You need to have a good overall vision of, okay, well, we've got a closed cycle that takes 15 days and that's unacceptable. We need to bring it down. Okay, are we cloud ready? Well, especially if you're in Excel today, you need to, and you're ready to take that next step. Well, cloud is where you're going to want to go. So that cloud readiness, the on-premise days are, the tools are still there and they're still very beneficial, but if you're going to step into a new technology, step into the cloud today. And the functionality and the features that we've been talking about here today, those are the type of things you need to consider when you're thinking, okay, do we need to upgrade? Do we need to do something different? Do we need to move or alter how we're doing things today? If we do, what can we change? What can we do better? Well, let's go back, and then you need to go back and refer to those features. Those are the type of things you can do better, because those are the best practices. Those are the things that have been desired or recommended or asked for across industries, across companies, and have proven to be successful for those who have implemented. And then with all the out-of-the-box features that we've been talking about, the implementation time is it's super quick. So, one of the questions I get quite often is, okay, well, which way should we go first? Should we go ARCS or should we go FCCS? Well, it really kind of depends on what it is that your company needs. We're going to dive right into this case study, and I'll go through it quick, just in the interest of time. But for them, their reconciliations were a monstrosity. They had so many, and it took too much time, and they were so inconsistent. And so for them, ARCS was most important. But for other people, maybe the other way around. Maybe the closed process and compilation of financial statements is more critical. So henkels and mccoy is the company we're going to be talking about real quick here. They have JD Edwards as their ERP system, and then they extract and pull everything into Excel, and everything was done in Excel. So that, I mean, it was just, they had an Excel nightmare in terms of the amount of templates and things they had to build out. So they had a huge reliance on Excel spreadsheets for all their manual reconciliations. They had various people who were preparing them, and so they were done in different formats with no consistency across them. You know, entries in their Excel files were lost. So those top sides were just buried within an Excel workbook that eventually either they were lost within cell formulas or referenced in some hidden columns, things like that. It takes a lot for someone to come in and be able to just pick that up and understand the flow of the values. It took a lot of time for them to be able to pull all the source information they needed. And it wasn't just their balance sheet, income statement, and cash flows that they needed. They had compliance reporting requirements. They had their budget reporting requirements, bank reporting, management reporting. So there was just, it was a reporting kind of a nightmare with all the information that they had to pull together. And then, of course, with cash flows being the most complex for most companies to put together, that took a fair amount of time for them to do. But now they can pull all of that out of the system. They've had just a ton of time saved on several hours saved on each process of the month-end close. They were actually able to now spend time analyzing the data, making their adjustments, making their reclassifications within the system, and being able to turn it around instantly and then review and analyze again. The turnaround time was huge, and the amount of late hours spent on things went down drastically. They extract their JD Edwards files. We had created some custom queries within JD Edwards and had it built to have them configure it to a way that reports easily into FCCS and ARCS. We utilized a lot of the pre-built reporting as well as did some of their custom reporting. So we had the pre-built forms and reports that out of the box FCCS provides. We used FCCS's seeded account hierarchy, and were able to then very easily build out several reports, including regional reporting and consolidated reporting. Now they're to the point where for them it was critical to be able to get out of their Excel workbook world, and we've done that successfully, and they're thrilled. And now they're to the point where, okay, well, now they want like a phase 2, a phase 3, more automation, they want to use the system even further. And there is definitely still room for enhancements for them. And so, but even just getting out of Excel and getting into a system was just amazing for them. And we were able to do that while coming in under budget for them. So that was huge. So just kind of high level for these guys, Oracle FCCS, We are able to import their balances from JD Edwards, eliminate all the manual time, all the manual adjustments they do in Excel, and reduce the time they spent putting together financial statements and managerial reporting. For ARCS, we were able to unify their process and approach for reconciliations. We added some auto reconciliation rules for them to reduce all the manual effort and minimize the amount of time they were spending on reconciliations. And we were able to enable, the ability for them to real-time track all of their progress. So at a glance, reviewers are able to go in and see where things stand. So that led to overall project success. On time, under budget, approximately 400% time saving on preparation of core financial statements and trial balance. That's huge. And then, of course, there's the process audit and log for greater visibility of iterations and changes to their data sets. That was something that was that is so difficult to manage in Excel. But at the end of the day, they're a happy client with a much improved reporting and compliance capabilities. Okay, so with that, I'd like to open it up for some questions.
Thank you, Nair. Please, populate the questions in the question box if you have any.
So I'm not seeing any questions. Did you want to?
I don't see any either. We can just keep progressing. I just want to let everyone know that the recording and the presentation will be sent out early next week. So as I mentioned in the very beginning, we do have other webinars in August coming up on account reconciliation. Nair, do you want to just cover this topic just really briefly? This is another issue that we've seen as we've done a lot of these FCCS implementations. So just give us like a quick overview.
Yeah, absolutely. So high level, there were a lot of early adopters on FCCS where things went wrong for various reasons, whether it was with it being on a different technology set, being more having the background of like a planning application, people coming in did not necessarily have the right tools to configure it. So there were a lot of FCCS implementations that had gone bad on the front end, and we've been able to come in there and remediate them. And so really excited about this topic, going to be able to go through these implementations and point to key items that have been problematic for clients and how we were able to help and turn things around dramatically. And
then we'll wrap out the series with this webinar towards the end of August. And I think this is a deeper dive into Oracle ARCS, but again, Nair, please give us an overview.
Yes, and so in this one, we're going to get into an ARCS application and demo some of these items that we've been talking about today. So just a nice deep dive into ARCS and understanding the application and the features.
Perfect. Lastly, I just want to remind everyone that we do assessments, complimentary assessments, no pressure, with our subject matter experts. And we have a lot of resources on our website. If you go to us-analytics.com and scroll over to our resources tab, you can access ebooks. All of our blogs are on there, prior webinars, everything that you might need in order to further educate you on any of the practice areas that we specialize in. So again, Nair, thank you for presenting today, and for all of our attendees today, please join us for the next 2 sessions that we've got coming up, and stay tuned as I email you that info. And we're here if you and when you need us. Thank you all. Have a great rest of your day.